Hello friends, it's Simon here with my latest video update. What I'm going to talk to you about today is the most pressing dilemma facing investors right now, and that dilemma is the question of where do I invest my money when everything looks really expensive? Because whether you look at stocks, bonds, property, or even limited edition sneakers, all asset classes today look very expensive when compared with history. So let's begin by looking at my favorite asset class, the stock market. So if we look at US stocks through the lens of the so-called Warren Buffett indicator, stocks are trading at a record high valuation. The stock market capitalization to GDP ratio is much higher than it's ever been, eclipsing the levels seen both at the peak of the tech boom in 2000 and also in 2007, just prior to the global financial crisis. Another popular long-term measure of stock market valuation is the cyclically adjusted PE, or Shiller PE, which compares stock prices with the average of the past 10 years of earnings. The Shiller PE currently sits at 39.65, which is higher than at any other time other than the peak of the tech boom in 2000. Now, why is this important? Well, it's important because the Shiller PE is remarkably accurate at predicting long-term future stock market returns. If you invest your money in stocks at a time when stocks are really expensive, your future expected returns will be lower than if you invest at a time when stocks are cheap. Okay, it's quite intuitive. Your starting point matters. Now, the current Shiller PE level of almost 40 implies average annual returns for the S&P 500 of negative 0.7% per year for the next 10 years. Now, let's take a look at bonds. Story doesn't get a lot better here. The role of bonds in an investment portfolio has traditionally been to provide a source of regular and reliable income, to preserve capital, and to hedge against a slowdown in economic activity. A slowdown in economic activity is usually bad for stock prices, but it's often good for bond prices. Now, US 10-year Treasury bonds are currently yielding around 1.5%. I'm sure you'll agree that's a fairly miserly income stream. But this only gets worse when you look at the US inflation rate, which is currently running at 6.8% per annum. Now, the real bond yield, which is the bond yield minus inflation, is the most negative it's ever been. So we've got the most negative real bond yields on record. This means that bonds, too, are really expensive. And when bonds are really expensive, they do not pay as much income. As you saw, the real yield is negative. And the other issue is that when bonds are really expensive, some of their ability to protect your capital is compromised by their high valuation. Because if they're trading at a really, really high level, of course they can fall in price. Finally, let's take a quick look at residential property. Now, much ink has been spilled on the housing affordability crises that are prevalent in many housing markets across the world. We've seen an acceleration not just in house prices, but also in house prices relative to incomes, which is what really impacts affordability. And the only thing that's allowed house prices to continue to expand the way they have is debt. But the net result, millennials have been completely priced out of the property market in many countries globally. Now listen in, because this next part is important. None of what I've discussed in this video means that stocks, bonds, and housing can't become even more expensive in the short to medium term. Valuation is not a good timing tool, but as you saw with the Shiller PE, it can be an excellent predictor of future returns. So, if you're uncomfortable buying or even owning assets that are looking really expensive by historical measures, what should you do? Well, I would encourage you at this point in the cycle to change your mindset. Change your whole approach to how you take on risk. If you've currently got a mindset of, I'm going to own a portfolio of risky stuff through thick and thin, and hopefully, fingers crossed, I'll come out of it okay in the end if it all keeps going up over the very long term. If that's your current mindset, I would encourage you to adopt a mindset of something more like this. I'm going to learn how to make money in both rising and falling markets, because markets go up and go down. I'm also going to learn how to identify high probability moments in time to expose my investment capital to risk, rather than have it exposed to risk all of the time in an expensive market. Now, identifying these high probability moments in time to take on risk is not only possible, it's actually simple when you know how. Wall Street wants you to believe that it's impossible to identify these moments in time because they want to charge you a heap of fees for managing your portfolio, for doing the impossible. They've got no interest in you empowering yourself to manage your own money. But if learning how to identify these high probability moments in time interests you, that is where my online education company, Tao of Trading, can really help. We offer world-leading education programs that will guide you through the process of identifying these high probability moments in time to buy or sell while managing your risk like a professional. Our methods are famous for being simple, intuitive, highly visual, and of course, very effective. Now, if you'd like to learn more, please visit our website at www.taooftrading.com or send us an email to info@taooftrading.com. I look forward to connecting with you.